In this video, I'm going to show you a powerful liquidity strategy that has made me massive profits in the market. This is the same strategy used by market makers, but I have simplified it in a way that's very easy to understand. So, if you are interested in learning, kindly hit the like button. Also subscribe to our channel and turn on the notification bell to stay updated with our latest strategies and insights. Now, let's get into it. The strategy centers around one key concept: liquidity. So, what is liquidity? Simply put, liquidity refers to areas in the market where pending buy or sell orders are stacked. Let's simplify it with an example. If you look at a chart and decide to place a buy order at a specific price, you're essentially offering liquidity to the market at that particular price level. Same logic applies when placing a sell order. So this constant flow of orders, whether from retail traders, banks, or institutions, creates liquidity at almost every price level. At any moment, there's someone ready to buy or sell, and this ongoing activity is what keeps the market moving. Still, some price levels attract more liquidity than others, which becomes crucial for strategic trading. For example, imagine there's a support level on the chart in form of a double bottom. Now, when this pattern forms, what do most traders expect? Of course, they would expect a reversal to the upside. So they jump into a long trade with their stop losses just below the support, expecting price to push up from there. You've probably seen this happen. Rather than bouncing off the support, price dips just below the support, hits those stop losses, then quickly reverses and moves upward. And this leaves you questioning why the setup failed. Well, here's the truth. Institutional traders deliberately go after the liquidity sitting beneath that support level. They know that many retail traders are watching the same structure and placing stops in that exact zone. So this concentration of orders is what creates a liquidity pool. And by triggering those stops, market makers absorb the liquidity they need to fill their own long positions. That's why price often dips below a key level before sharply reversing. So in this video, I'm going to teach you how to become part of the top 1% of traders who know how to capitalize on this pattern, so you don't end up like the other 99% who constantly get stopped out. This approach often works better on lower time frames, such as the 5-minute or 15-minute charts, and it's effective across all markets, whether you're trading forex, crypto, or stocks. To make everything clear and easy to apply, I'll break this strategy down into 4 straightforward steps. It's important to understand that each step works in connection with the other, so ensure to watch till end so you don't miss out on any. Now, let's start with the first step: identifying a break of structure. Before we dive into that, let's do a quick recap on how market trends form. As we all know, there are 2 basic types of trends: uptrends and downtrends. In an uptrend, price moves in a rhythm, creating higher highs and higher lows. In contrast, a downtrend is formed by price creating lower highs and lower lows. Now, a break of structure happens in an uptrend when price breaks above a previous high and makes a new higher high. While in a downtrend, a break of structure forms when price breaks below a previous low to form a new lower low. Recognizing these shifts in structure is the first crucial step in executing the strategy effectively. Now that you understand what a break of structure means, let's apply it to a real chart example. In this chart, we can observe that the price is consistently making higher highs and higher lows, which signals an uptrend. To identify the break of structure, we focus on the point where the price broke above the previous high and establishes a new higher high. This specific move marks our break of structure. Once the break of structure has been identified, we can proceed to the second step. But before we continue, let me quickly share with you a valuable opportunity that could generate massive income in the crypto space. In 2025, many still look back at 2021, the days when one Elon Musk tweet could send a coin pumping by 18,000%. But the market has evolved. Real opportunities now depend on strong communities, transparent teams, and institutional-level infrastructure, not hype alone. After doing my research, I believe I've found a project with real potential this cycle. It's called Nomy. Nomy is a global platform for growing and managing digital wealth, strategic ventures, and also technology provider. The platform is built by experienced crypto market leaders. It offers institutional-grade earning products for both retail and professional users. Here are some exciting things about Nomy. Over here, you can see that Nomy has been in existence for 6 years, has over $7 billion on insurance, and over 1.5 million users worldwide. That's not all. They also have over 200 supported jurisdictions, more than 700 assets to earn on, and has paid a whopping sum of $91 million in interests. This project is also fully regulated and has a complete security. It has been operating since 2019 and has a quality support in case you need help. Here you'll find video reviews from some crypto experts, so you can watch and see what people are saying about Nomy. Below here are posts and mentions from both influencers and top-tier media outlets endorsing Nomy Finance. When it comes to community engagement, Nomy demonstrates strong numbers, with about 53,000 followers on X and over 36,000 subscribers on Telegram. Now, let's take a look at how you can start generating income through this project. First, you have to create an account using the link in the description below. For me, I already have an account, so I will just sign in. So when you fund your account, this is where your total balance will be displayed. Now, on the interest account section, head over to fixed deposits. Here, you can make fixed deposits using any of these crypto assets to get an APY of up to 153%. Right now, I am going to make some fixed deposits with the money I just funded on my account. So I will just click on deposit. I want to deposit from my wallet balance, so I will uncheck this one. Here, you put in the amount you want to deposit. I will go with 0.045 Bitcoin, which is equivalent to $5,000. You can also toggle this on to get your interest monthly, but it will result in lower interest, so I will just ignore it. This is where you select your staking period. I will just go with 9 months for this particular deposit, then I will click on Continue. Here, you can tick this box to increase your profit by converting the deposit to Nomy. When you tick the box during deposit, you get some benefits. Your deposit converts to Nomy tokens. You automatically participate in the Nomy presale. You earn daily staking profit in Nomy, and you will also receive higher APY in Nomy and additional profit from potential price growth after Nomy listings. But if you leave the box unchecked, your daily profit stays in the same currency you used for the deposit. I will just leave it unchecked, but I will do that in some other of my deposits. Then, ticking the second box, you agree to the terms and conditions, then click on Create. Now, after completing your first staking deposit, you will automatically receive a welcome box. Click on this box icon to see it, then click Open. As you can see, I got 1,800 Nomy. Prizes range from $50 to $10,000 in crypto, instantly credited to your wallet. Now, I want to capitalize on this opportunity, so I will just go ahead and make further deposits. So I have successfully created 3 fixed deposits. Nomy is also running a community giveaway. To participate in the giveaway, all you have to do is buy Nomy, create staking deposit, and join Nomy launch pool. Every action gives you +1 entry. On August 30th, a snapshot will be taken. The more entries you have, the higher your bonus and chances to win. So, explore the Nomy platform, stake your crypto, open prize boxes, and earn daily profits with institutional-grade tools. Now, back to the video. The second step is identifying a supply or demand zone. As we all know, supply and demand zones are key areas on the chart where significant buying or selling activity occurred, resulting in a strong price movement. The simplest way to locate these zones is to first identify a break of structure. Then, trace back to the origin of the sharp move that caused that break. In an uptrend, the zone just before the strong upward movement is known as a demand zone. Conversely, in a downtrend, the area preceding a sharp drop that led to a break of structure is referred to as a supply zone. Going back to our original example, now that we've identified the break of structure, locating the demand zone becomes much simpler. We focus on the point just before the strong upward move that caused the break. In this scenario, the price started its sharp rise from this level. To define the demand zone, highlight the last candle before the sharp move, and use the rectangle tool to draw a zone from the candle's low to its high. This highlighted area now represents our demand zone. With the demand zone now identified, we can move on to the third step, identifying a liquidity level. Arguably the most crucial part of the entire strategy. In simple terms, liquidity levels are zones where a large number of stop-loss orders are clustered. Common examples include double bottoms, triple bottoms, or areas where price has repeatedly been rejected. When a level appears to be a clear support zone, many traders tend to enter long positions and place their stop-loss orders just below it. This creates a concentration of liquidity beneath that level, making it an ideal target for stop hunts by larger market participants. So, our goal is to identify a liquidity level positioned just above the demand zone. Typically, price will break below this liquidity level, grab the liquidity, and then bounce off our demand zone. This bounce on the demand zone presents a long trade opportunity. The same principle applies in a bearish trend. In that case, we look for a liquidity level below the supply zone. Price often breaks above this liquidity level, grabs the liquidity, and then reverses from the supply zone. That reversal becomes a prime shorting opportunity. Returning to our original example, since we've already identified the demand zone, the next step is to locate a liquidity level just above it. In this case, we can see that price has formed a double bottom, rejecting the same level twice. This indicates a buildup of liquidity beneath that level. Once we've identified the liquidity zone, we move on to the final step, trade entry. The entry process is straightforward. Just place a buy limit order at the top of the demand zone, set your stop loss below the zone, and set your take profit at the next significant high. And watching the trade run, you can see how price pushed down and swept the liquidity, then bounced on our demand zone and pushed upward, giving us a winning trade. Same principle also applies to a bearish trend. So by mastering this liquidity strategy, you'll significantly enhance your trading performance and profitability. If you found this video helpful, don't forget to hit the like button, also subscribe and turn on the notification bell to stay informed whenever we make new videos.